Hey, I'm Jason. This is Supply Demand Daily. I keep tabs on the economy so you don't have to. I hope you're having a wonderful Friday, June 17th, 2022. Today I'm going to be talking about industrial production and I'm going to be talking about inflation in the Eurozone. And if you don't know exactly what the Eurozone is, that's okay. I'm going to show a map of all the different countries that are in it. And if you don't know what industrial production is, again, that's what I'm here for. So let me get out of the way so we can dive right in and talk about some industrial production. Now, my favorite advantage, first of all, what is this industrial production index thing? My favorite thing about the index is that this is one of the few things in economics that you are able to separate the effects of prices from. And that's because industrial production has nothing to do with prices. It's not a measure of spending, it's all quantities. So what industrial production does, what the index does, is it measures the difference between how much of a bunch of different kinds of stuff. We're talking about utilities, we're talking about energy, materials here. We're not talking about services. We're talking about utility commodities. We're talking about energy and manufactured goods and all of these different kinds of things. So it's the difference, the rate of increase in how much of those things were produced in 1 month versus the month before. And of course, you can do that. You can take comparisons year over year as well. All right, so this is a measure of economic growth and activity and vitality that does not have anything to do with prices, which is especially important because prices have a tendency to change and they can make bad situations look a lot better than they are, which is why even though, a couple days ago, we looked at retail sales, and the retail sales look amazing on a nominal basis, not adjusted for inflation. But then when you add in the effect of prices, it's not great. So what happened with industrial production? We had a month-over-month growth rate of 0.25%, which was below the expectation that was made by Wall Street and industry forecasters of 0.4%. Now, the average growth rate over the last 5 years is about 0.13%. Industrial production, as I'm about to show, has had very to use an interesting word, paltry growth over the last 14 years, ever since the great financial crisis. And instead of just talking about that, I guess I can just, go ahead and show it. So this purple dashed line, that is the level that we're currently at. What I was showing here in this chart is 5 years of monthly percent growth rates. So going back to 2017, the month over month rate of growth. What is this huge crazy downtrend right here, this huge crazy bar that just goes all the way down, almost negative 15%. That would be the first and second months of lockdowns in March and either March and April or April and May of 2020. And then we started to see a bounce back after that. That's what we're looking at here. And now I'm going to show a longer run, just going back to 2000. By the way, this series actually goes back over 100 years. It's one of the few data series that does that, all the way back to 1919. But anyway, so this is going back to 2000, and the reason that I show this graph is to make the point that between the recession of 2000-2001 that happened after the bursting of the tech bubble, there was a solid improvement after the recovery in industrial production. And if you look at previous business cycles where the United States goes into recession, which is associated with less industrial production, as we see in these dips here, right? And then what usually happens is there's an economic recovery, and somewhere in the middle of the next cycle, or maybe even the beginning of the next cycle, industrial production will recover completely the level that it was at before, and then it will expand beyond that until that particular expansion cycle, that growth cycle, ends. But after the great financial crisis, after the Great Recession, we didn't see that. So we're actually seeing a relative all-time high, not a relative all-time high, we're seeing we're seeing an all-time high in this level of the index of industrial production right now in 2022. And that all-time high, think about this, is only 3% higher than the quantities of manufactured goods and base materials that were being produced in 2008. That's what this chart is telling you. And it's also, what it also says is that, first of all, it took us years after 2009 all the way up to 2015 to get back to a level that was comparable, it was comparable to 2008. And we basically just bumped up against this ceiling all the way through the, the Great Recovery that we saw after the Great Recession of 2008, 2009. So it's a very interesting chart, and when you live in an economy like we do, it's not supposed to look like this. If you look at the first, actually, this looks a lot more like the 1930s than any of the major expansions in the record of our economic history. If you were just to look at industrial production, you'd say, oh yeah, that looks kind of like the 1930s, which were not good times in American history. So did I mention everything I wanted to look at there? Yeah. So the 22-year average growth rate, which is going to be obviously yanked down by these really large dips that we've had in the last several years. This Great Recession and then the lockdown recession that we had. So that has a big influence on this 22-year average, but that is a growth rate of about 0.06%, which is basically none. I mean, that might as well be zero. And, again, compare where we were in May of this year to that, and 0.25. That's not bad. But when you are in the fresh, still in the first couple years after an economic recovery, trying to come back from a really big recession where a lot of people lost jobs, you really want to see numbers that are higher than that. And historically, you would have at this point in the recovery. So now, Eurozone inflation in the Eurozone. This is a 19-member bloc, and the thing that makes the Eurozone is we're not talking about the European Political Union, which the United Kingdom was formerly a part of before they Brexited in 2016. We're talking about the European Currency Union. So these are the countries exclusively that have elected to use the euro as their primary currency. They decided to replace their own currencies way back in the day in the late 90s, and now they use the euro. So that includes a lot of different countries that you definitely think of when you think of Europe. You got Italy, France, your Germany, your Spain, your Ireland, all these different, Greece, and then, these post-Soviet states, Estonia, Lithuania, and Latvia. That's the other one of these small ones in the dark blue here. Who is experiencing the highest inflation rate in the Eurozone? That would be Estonia, one of these post-Soviet states. Again, one of these darker shaded ones, which are shaded dark because of their relatively high inflation rates. And who is experiencing the lowest inflation rate in the Eurozone? That would be France. And they currently are in a tie with Malta, which is this tiny little island nation off the coast of Sicily. But that is not the bulk of what I wanted to mention about Europe. We're going to go through some charts on the Eurozone inflation situation. So this is, again, a chart that goes back 20 years because the Eurozone was just brought into existence in 1999. So this is as far as it goes back. But the orange line that I'm showing here is the overall inflation rate in goods and services for the Eurozone. And when we say overall, we're talking about all the goods in their harmonized index of consumer prices, their HIC, HICP. That's what they call. It's like the United States CPI. They just have a different terminology for it. And then the blue line, the dark blue line, is the core inflation rate. So the key distinction is, like in the United States, the core inflation rate does not include food and energy prices, and the overall inflation rate does. The overall consumer price index does. That's basically the distinction there. And as you can see, we're looking at an overall inflation rate that's very similar to the United States. We have 8.1% in the overall inflation rate in Europe as of May 2022, and the core inflation rate was actually quite a bit lower at 3.8. This is a much bigger differential that we see in Europe than we see in the US. So I'm going to show another chart here in a couple slides that shows you just how big that difference in differential really is. But to give another comparison, actually this is it. So in the green line, what I'm showing here is the core inflation rate in the United States, and the blue line is just the same thing that the blue line was in this previous chart. It just looks a little different because it's being compared against a different set of numbers, right? So for core inflation in the US, we're sitting at about 6.1%. In April on the year, it was 6.3%. And in Europe, we have, as I mentioned, 3.8%. But what I think is really interesting about these two things is that the difference between overall inflation and core inflation is a lot bigger in Europe right now than it is in the United States. So in the green, this is showing you the US again, but what it is instead of just one of these rates, it's the difference in the two. So you take the overall inflation rate and subtract the core inflation rate, and you get this green line here. And then the blue line is the same thing if you just do it for the Eurozone. And what you notice is that these two differences used to track each other pretty closely, and historically they have. In the last 10 years, though, the Eurozone inflation gap, let's just call it an inflation gap for now, or we could call it maybe a food and energy gap. But it used to track the U.S. gap pretty closely, and it's gotten a little bit larger, like systemically, frequently larger than the U.S. gap here in the last 10 years. And now, back in basically the fall of 2021, looking at August, September, is when it really started to diverge away from that which we see in the United States. Why is that? Well, it's basically because for Europe, the energy prices, not the energy prices, but prices are a part of it, but the energy crisis that is starting to seep its way into the United States economy now, well, they've actually been dealing with that since the fall of 2021, as has major countries in Asia, such as particularly China. So a lot of places in the world have been dealing with this whole energy situation a lot longer than people in the US have, and it's now just beginning to catch up. It wasn't in oil necessarily before in Europe, but what it was in is natural gas. Natural gas prices have increased considerably in Europe, and because Europe is now dependent on Russia extensively for its natural gas and has made efforts to completely denuclearize its economy, at least in the case of Germany as well as France in more recent years. Germany made a decision back in 2001, a lot of people don't know this, or actually I think it was 2000, to completely get rid of nuclear as their energy mix. And so this was a very large source of energy independence for Germany. And over the last several years, they have been actively closing down plants, which means that they have to get their kilojoules from somewhere else, and that somewhere else has been Russian natural gas. France has made efforts to do the same thing, albeit not on such a grand scale, but their energy generation has decreased as well. And so with this increase in energy independence in Europe, has been coupled with a decrease in energy independence in the United States. So in the early part of the 2010s, we had the fracking revolution, and now we pretty much supply all of the oil in the United States that the country requires, and we end up exporting a lot of it. And so we have a we have a smaller gap between overall inflation and core inflation, which can be explained by the difference in independence on energy imports. I think that's a lot of the explanation. And again, that's why you see this thing start to jump in September, October of 2021, coinciding right with the energy crisis that started to plague most of the rest of the world, except for the United States. So that's these sorts of policies definitely have consequences. Next week is going to be the celebration of Juneteenth. So Monday is, what is it today? 18? Yeah, Monday is the 19th, or no, that's not right. Sunday is the 19th. And so if you are fortunate enough to have the day off on Monday, I do wish you a wonderful long weekend, and I will be back still on Monday with some economic data and some commentary and other stuff. But I hope you've enjoyed this quick episode of, was it quick? It was somewhat quick. This somewhat quick episode of Supply and Demand Daily, and I hope to see you back again next week. And again, enjoy the weekend. Hope you have a wonderful rest of your Friday. Thank you very much.